Hey everyone, in today's video, I'm going to talk about some updates that I've been making in my $230,000 Wealthsimple stock portfolio. We're going to go over how my stock portfolio has been doing recently. In addition to that, we're going to talk about some drivers in my stock portfolio to the gains I've been seeing, as well as the overall economy, before talking about how I've been looking at my portfolio, what stocks I've been buying in my portfolio, and I'm looking to continue buying in my portfolio throughout the rest of the year. So if you like this kind of content, be sure to give this video a big thumbs up. Consider subscribing to the channel and we'll just get right into it. You see here, overall, I'm up about 8% in my portfolio. In the last month alone, I've been up 6% or $8,000 on the Canadian side. In the last week, also trading at about $2,500. On the US side, up about 2% in the last week, and also up about 6-7% in the last month. So out of that 8% gain I've seen in the history of my portfolio, about 6% of it has come here in the last month. So obviously it's been a great month for my portfolio, but it's not just my portfolio. As well as I'd love to say I'm beating the market by that much. The overall market has been trending up really nicely. You see here the top 60 companies in Canada up about 5.8%, so pretty much in line with my portfolio. The S&P 500 here up about the same amount in the last month. So the overall market has been absolutely roaring. Now, this is after a bit of a downturn over the couple months prior. So in my previous updates, it's been a lot more gloomy, but we've really seen a nice rebound here in the S&P and the Canadian markets in the last month or so. So what really drove this gain broadly in the markets and in my portfolio? Well, the first thing is inflation. Inflation beat expectations by coming in lower than expected in the October inflation numbers. So core CPI hit a 2-year low in terms of the sequential growth. You can see the chart here. You're starting to see the growth really slow down in terms of inflation, which is really strong, points to potential signs that we may be able to deliver a soft landing in the economy, get back to normal inflation levels without dramatically hurting the economy and have very high unemployment. So that was really good signs in the inflation report that we saw. And that was the biggest reason in the last 1-2 weeks that the market's been trending upwards, because lots is priced in that inflation may hamper discretionary spending to a very great degree. And if that may not happen, that means that these values in the market should be getting corrected on equities. And I'd say the second big bucket is stock earnings. So lots of stocks have started to report earnings in earnings season. And generally speaking, I'd say many stocks, especially the consumer stocks, are beating expectations. Target is one here that I'm just going to pull up quick, but Target roared after their earnings release. We see here in the last week up 20% on Target. Another one that I own personally, Jameson Wellness, has just gotten hammered on fears that discretionary spending may negatively impact their business. Looking at that stock after their earnings report, they're up huge as well, almost 20%. So it's lots of these consumer-esque companies that have just beat earnings in a really nice way, really not seeing hurt in the momentum of the discretionary spending on their businesses. And that just goes into the story of inflation coming down nicely, but still not hurting discretionary spending on lots of these businesses, which is like a best case scenario. And we're starting to get some of that priced in a bit more. So that's something that we should keep an eye on, should be wary of, but definitely some good signs in the last month here. In terms of specific buckets of my portfolio that's been doing really well, the first one is banks. So banks, just behind the sentiment of consumers potentially not being as hurt or as impacted as we previously thought they may be in this quarter, in the upcoming few quarters, banks have rebounded nicely. So we have Bank of Nova Scotia, here, up about 8% on the month alone. Looking at this one, I still like the valuation of this one. Trades at about 8 to 9 times next year's earnings. Dividend yield of close to 7%. So while it's up 8%, this is one that I definitely don't think is done going up or still has a lot of value to give between a multiple correction as well as the dividend they're offering. Another bank that I own, and probably my favorite bank stock in my portfolio across accounts, is TD Bank here. TD Bank up to $85. Looking at this one in the last month, up a similar 8%. And that's really been continuing over the last week, up about 3.5% alone in the last week. You don't get as good of a dividend on this one, about 4.5%, but they do have, I'd say, better exposure in terms of being solely in Canada and the US, probably better brand, better book, a better diversification as a commercial bank. So that's something to keep in mind when deciding if you're picking individual banks, things you may want to put into consideration. With that being said, they do trade at a bit of a higher multiple. I think they're expected to do about $8.50 of EPS next year, so trading right around 10 times earnings here. The second area of my portfolio that's really driven it higher has been REITs. So REITs, I'm just going to pull a couple of them up, but I own a ton of REITs, especially across my portfolio. And on this one, up 7% on CapREIT in the last month. In the last week here, just up about 1.5%, so more pronounced over the last month. But these REITs really respond in a huge way when interest rate outlooks change, and interest rate outlooks are, for the most part, a byproduct of those inflation reports. When those inflation reports start slowing down in terms of sequential inflation, the outlooks on interest rates and treasury bills tend to slow down too, which is extremely positive for REITs. First of all, their cost of capital outlook goes down, so the cost to service debt goes down, and lots of these REITs, depending on the quality of the REIT, either have 30 to 55% of the total value of the real estate tied up in leverage and debt. So when interest rates are going up, that just puts a huge burden on them to pay off those debt servicing costs, and it becomes extremely challenging to not only pay off the interest but start lowering the overall debt. At the same time, they're paying a dividend, they're trying to grow their business, etc. So it just puts a lot of headwinds on these businesses. But inversely, when rates start going down, it just opens up a lot of extra capital and extra cash flow for them to invest across their business, return capital to shareholders, buy back shares if they see big gaps on their share price to NAV, etc. So we're starting to see the clouds clear a bit on interest rates, and we'll see how it actualizes. We'll see how it transpires month to month and quarter to quarter. This can very well go back up again next month in terms of the CPI report, and that will have the negative effect on these REITs. But in a world where these REITs are getting treated a bit like a proxy to interest rates, and interest rates going down, sending REITs higher, I have been hit over the last handful of months. You see here down 15% on Allied Properties, partially driven by that same effect, except rates going up. So it's nice to see me getting the other side of the stick here, up 5-6% on lots of these REITs in the last month. Going on to the third thing that has really been helping my portfolio in the last few weeks, it has been big tech. So you see big tech here. Let me get a couple of them up. I own Google, I own Microsoft, I own Facebook. Those are all pretty much in my US account as I say it out loud. So Microsoft here, you can see here in the last month, stock's up another 13%. So this stock has been absolutely on a tear, up over 50% in the last year. Personally here, up about 50% overall. But seeing this stock continue to roar higher has really made a really nice impact on my portfolio here. This position is about $10,000, so 10% is about $1,000 US gain just in the last month. And these are phenomenal companies that are in spaces that have tons of tailwinds, tons of growth opportunities, very high growth rates on lots of elements of their business. So it's spaces that, while the companies have started to get a bit pricey on price to earnings ratios, have not been ones I've wanted to sell out of. And same impact, but for a different reason on interest rates with these ones. While it doesn't necessarily impact their day-to-day operations, it does impact the opportunity cost of holding these companies with longer out earnings instead of a treasury bill where you can yield 5% today. So when these interest rates do go down, these higher PE companies with larger growth rates do typically respond favorably as well. And I'm seeing that on Microsoft here, going back into my portfolio. I'm also seeing that on lots of my other big tech companies. Meta, in the last week alone, up 3%. In the last month, up 9%. And then Google's the last one. They had some rocky elements to their earnings, so they're a bit less impacted here, about flat in the last month, but was up about 2.5% last week, behind that inflation report as well, in my opinion. Looking at the final reason that my stocks have been performing pretty well in the last few weeks, and it's really been earnings. A couple of my stocks have reported really strong earnings in the last few weeks. One of them here is S&P Global. S&P raised their outlook in the last few weeks, and you can see here stocks up over 16%. These are not small companies or volatile companies, typically, long-term speaking. So to see a stock like S&P, which is over $100 billion company, up over 15% in just a month is really amazing to see. You see here $130 billion valuation now on this name behind their strong results and outlook increase. Another one that reported really good numbers here that I wanted to share was actually Visa. So Visa here, you see their revenues in Q4 up double digits, income up about 20%, and then because they buy back shares, their EPS was up 21 to 22%, depending on what metric you want to look at. So this is really phenomenal growth, double-digit growth across the board, 20% EPS increases, and then just looking at key business fundamentals, payment volumes up almost 10%. That's not dollars, that's volumes. And then you see intra-Europe up 18%. That was an area that lots of investors were worried about growth in. Processed transactions up 10%, cross-border 16%, double-digit growth across all fundamentals of their business. EPS up 20%, revenues up double digits. They're firing on all cylinders there, and their stock price has responded, going into Visa here up to $250 a share. That's probably close, or if not at an all-time high. Let's see if they hit 250 here. Nope, they're probably sitting right around an all-time high here at 250 a share. But I still don't think the company's at a crazy valuation. They're expected to do close to $10 of EPS next year, which puts them just over 25 times earnings for a company that's been compounding 20% EPS growth despite the challenging environment. Over the last number of years, even through the pandemic and whatnot, they've had very similar growth trajectories. So they have a long runway of converting cash into card payments. They also are looking at other growth opportunities to get more payments in their network. So yeah, Visa never looks particularly cheap, but they've continued to deliver really strong fundamental business performance and overall shareholder return growth through buybacks and dividend increases, even though that's a small part of their mix. So that's another one that's performed really well after their earnings. We looked at Jameson earlier on in the video in terms of one that's really helped me out in the last month. This one I was down pretty big on. Now I'm up 12% on it in the last month here. You see almost 20% up. And I'm just scanning through to see some other ones that have reported earnings recently. Rogers had really good numbers as well, looking at that one in the last month, up 16%. This is abnormal high performance for some of these stocks that are more utility-based stocks. It's just the perfect storm of interest rates looking like they may trend down, really strong business earnings, really good sentiment and outlook on the consumer, and all of that together can make these really historically boring stocks deliver 16-17% growth on top of their dividend in just 1 month. So I don't find these stocks to be overly boring, even though lots of investors may believe so, especially younger ones who are trading like volatile, unprofitable companies. But you still get opportunities for big capital appreciation gains, even on these hardworking dividend stocks that tend to be a bit lower volatility over the long run here. But overall, I'd say that's the fourth thing that really propelled my portfolio higher. Just not really too many misses on earnings, but I've seen a lot of gains through earnings over this earnings period. So I just wanted to wrap it up with talking about a handful of stocks that I've been adding to, going to continue to look at adding in my portfolio. The first one is Ryokan here. Ryokan is another REIT, and I haven't been going too hard into REITs just because I do have a lot of exposure to REITs across this portfolio, across some of my other accounts. And I do acknowledge that they are not in the best space they've ever been, with interest rates where they are, with potential risks with governments, as well as office, especially as a space of REITs not performing well, retail potentially having weakness if the economy goes down. But I do think, especially given the news that we saw this past week with inflation starting to decelerate, some of these REITs are of high quality, not office anchored like RioCan, primarily grocery anchored, which isn't really going anywhere. And they're trading at under 10 times funds from operation. RioCan reported earnings this week or two last week, and I think they held their guidance for the year about $1.80 of funds from operations, which puts them at about a 9.5 times funds from operations. So I'm getting over a 6% dividend yield on a company that is trading under 10 times, really solid assets in flagship locations, lots of large city exposure. And in addition to that, they got a question about their dividend and if they'd be continuing to increase their dividend as they have for the last few years. And the general answer on their earnings call was, yeah, they're looking at maybe deciding how much they recommend to the board to increase it. But this 6.1% dividend yield is just a starting yield. If they can increase their dividend in a year that we've just had with interest rates where they are and some of the business fundamentals of real estate and construction where they were, and they can still increase their dividend, I feel really confident in the long-term dividend growth opportunity, and we're getting in at over 6% starting yield. So that's one that I just added, I think, about 15 more shares. Still a very small position in this account, but it's one that I'm going to look at potentially adding more on if they stay under that 10 times funds from operation level. Another stock that I've been buying more of is one that hasn't really been taking part of this rally in the last month, despite having pretty good earnings, in my opinion, themselves. That's Coca-Cola. Coca-Cola in the last month has rallied about 5%, but this was after they have been going down, and they went down mostly because of fears that Ozempic was going to wipe out demand for sugary drinks, wipe out demand for beverages, and then they performed really well on their earnings, kind of played down that sentiment, and the stock rebounded, but still not all the way back to where they were. So in a market where lots of the stocks I was buying are up 10, 15, 20% in the last month, 5 weeks, Coca-Cola is one that I still like. The multiple it's trading at I believe, around 22, 23 times this year's earnings, but it hasn't run to the same extent. And I'm not fully bought into Ozempic wiping out their business, wiping out these businesses. And even if they do start to chew away at it, Coca-Cola is not only a sugary drink company. They also have coffee, water, all these other businesses, and they continue to pivot to whatever trends consumers are looking for in the market. And I believe they'll be, on top of that as whatever trends transpire over the next number of years. Another one that I'm looking at on the US side is Realty Income. Realty Income has gotten hit a lot more than lots of other REITs, which surprised me because this one is a really high quality REIT. In the last month, I actually bought a couple, I think 5, 10 more shares on weakness at the beginning of the month, under $50, as they announced that they were acquiring Spirit Realty for about $9 billion, which is a huge acquisition. It's about a $40 billion company. So they're doing it on a share basis, so diluting shareholders by about 20%, give or take, to get Spirit's assets. Some things I like about this, don't like about it. I like the industrial exposure to diversify their business a bit more away from retail. So that I did like. About 25% of Spirit's business is industrial. They did announce that they did have a couple percent office in there. That Realty Income on the call said they may eventually look at spinning off, and they don't consider it as core assets. But they'll monetize that at a time where they can get a fair price for it. But I did like the industrial side of it. The other side of it is it does expose them to some of their top clients here. You can see they went from 3.8% to 3.4% on Walgreens, Dollar General, and whatnot. The only top 20 clients that actually went up was Lifetime Fitness and BJ's, for the most part, Home Depot as well. So a bit more exposed to Lifetime now than they were. I don't like the fact that the tenant mix at Spirit from the retail side didn't look as good. The portfolio didn't look as high quality, and they didn't have as much international exposure as Realty Income. So for me, it was a bit of a wash. Yes, they get more scale. Yes, they get a bit more diversification into industrial, but they also probably took a bit of a lower performing or lower quality asset base and added it and mixed it into Realty Income. So pros and cons on this one, but overall, I did not think the share price dropping about 15% in one day or in a couple days was was something that made sense. It went from about $50 to low 40s. Pretty much means on an adjusted basis, when you look at the dilution that Spirit is going to provide coming in, you're pretty much got all the Spirit company or Spirit real estate that they're coming with for free if you bought right away at that new share price. So I kind of acted quick, bought 5 or 10 shares on that one. But this is one that even at a 5.75% dividend yield, I may look to get this closer to 200 shares by the end of the year. Given the multiples they're at, they're going to do about $4 of funds from operations, so trading at about 13 times earnings right now for probably the highest quality triple net lease mega size REIT in the world. So I like the size that they're building the company to be. Really makes it a lot more defensible, gives them better buying power and better earnings power, better scale. So this is one very different play than lots of the Canadian REITs, diversifies my REIT exposure a bit, and really like the monthly dividend that they pay and tend to increase on a quarterly basis too. So those are some of the stocks that I'm looking at buying in my portfolio. The other one that I have been adding to, which isn't really a stock, which is why I saved it for last, but I added cash back in to my portfolio, put about $3,500 in this one. This one just pays me a high interest distribution every month of about 5% annualized, give or take. And in a world where, the market's been so volatile, looking at my overall portfolio up 7% in just 1 month, I thought it would be prudent to, not invest as heavily in a market that lots of the stocks I'm invested in just went up 10%, 15%. So that's just me putting a bit of cash to the sidelines, building up a bit of capital for if the market does trend down in the weeks to come, in the months to come, behind maybe more negative CPI reports, maybe worse just consumer sentiment or earnings reports. So I'm trying to put some dry powder on the side as well in the wake of this increase in the market. You rarely see TSX and US markets go up over 5% in a single month. So that's what I've been up to in my portfolio over the last couple weeks. Thank you guys so much for watching. Let me know in the comments your thoughts on any of these stocks, what you're doing in your portfolio. And if you made it all the way to the end, let me know in the comments as well. Not too many people do make it to the end. Be sure to like this video if you like this kind of content and subscribe to the channel for more. Thanks for watching, and I'll see you in the next one.